Has the Fed changed the approach that it uses in assessing severe weather risk over the last 10 or 20 years?
We've had a policy in place. I would tell you there's been quite a lot of research done at the Fed around severe weather and its effect on the economy, and we do incorporate that into our supervision of these institutions. So it's definitely evolved. I think we have a, cutting-edge understanding of the effect of severe weather events on the economy, and we do incorporate that into our supervision.
But has the process changed?
Has the process changed? I'd have to go back and look.
And the reason I'm asking this specific question is that severe weather, generally speaking, over the last 10 or 20 years has been treated sort of force majeure. It can't be helped, and to a certain extent, it can't be accounted for, except that there's this sort of outside risk. But when that risk, say, of a 500-year storm rises 10x in, say, 15 years, then the question becomes, are your systems adequate to the conditions on the ground? And I can take that for the record if you don't want to puzzle through it.
No, I can. I mean,
mic'd up. Go ahead.
One way to get at that is to go back to Superstorm Sandy. In a world where you have water lapping at the foot of the New York Fed, which is not that close to the water, in downtown Manhattan, you know that you're going to need robust plans and redundancy and all those things to deal with severe weather events. And that happened in, 2013 or 14. So we know that, and we do apply very high standards to the key payment utilities and other financial institutions.
Let me read you something from the Bank of England. The costs of climate change are having a devastating effect. As financial policymakers and prudential supervisors, we cannot ignore the obvious risks before our eyes. We must integrate the monitoring of climate-related financial risks into the day-to-day supervisory work, financial stability, monitoring, and board risk management. Do you agree with the Bank of England?
I guess I see climate change as a longer-run issue. I don't know that incorporating into the day-to-day supervision of financial institutions would add much value. We have lots of things to supervise them for.
Let me make the case for day-to-day supervision, especially prudential supervision. You measure cybersecurity risk, political risk, balance sheet risk. You measure risk. This risk is accelerating. And I understand the desire for the Fed to sort of stay out of the political fray and even to stay out of the public policy fray. But this risk is accelerating, and I am satisfied that you're puzzling through this and that the staff is trying to get this right. But I am not satisfied that you are drawing the correct distinctions between weather and climate, and that you're adequately accounting for the increased frequency and severity of severe weather events due to climate change. And there's one other part of climate change. It's not just individual events. It's changes in weather patterns that could cause individual portfolios to be more at risk. And so do I have your commitment to continue to work with our office on this problem, especially given that, as you know, more than a dozen central banks around the planet are working really hard on this. And again, without an ideological lens, but just to try to adequately measure the risk.
Yes, and I'll also say there's really nothing going on in the other central banks that we're not quite well aware of, as I think you know.